Hey everyone, and welcome to this explainer. Today, we're going to dive straight into how one single, honestly kind of shocking employment number is sending massive ripples through the entire US economy. You know, when monthly jobs data drops, it's rarely just a static number on a page. It's a live pulse check on the whole economic machine. And today, we're looking at a pulse that just skipped a beat, and it is completely altering the conversation around financial markets, investments, and ultimately, your wallet. So, could a disappointing jobs report actually change your borrowing costs? Okay, let's unpack this incredibly counterintuitive macroeconomic mystery. At first glance, a weak jobs report sounds like purely bad news, right? I mean, why would anyone celebrate fewer jobs? But to Wall Street, bad economic news can sometimes actually be interpreted as good news. We're going to break down exactly why Wall Street sometimes cheers for lower job growth and how a slowdown on Main Street can literally dictate the interest rates you pay on your mortgage, your car loan, or your credit cards. Section 1. The June jobs drop. A sudden shift. Let's start by looking at the stone that hit the water and triggered this entire economic chain reaction. 57,000. The United States added a mere 57,000 new jobs in June. Now, you might be wondering, why is this specific number such a big deal? It's because it landed so incredibly far below what economists were expecting. Analysts were actually bracing for something closer to the 200,000 mark. So seeing only 57,000 jobs added, that signals a very sudden, very real shift in hiring sentiment across the country. Businesses, it seems, are suddenly hitting the brakes. Moving on to Section 2, a cooling U.S. economy and the domino effect. Let's see how this builds out into our first ripple, which hits Main Street directly. What we're looking at here is a clear domino effect of how a cooling economy actually takes shape. First, exactly as we just saw, employers get cautious about the economic horizon and they start hiring less. Step 2, fewer new jobs in the market naturally slows down overall income growth for American workers. And then finally, step 3, with slower income growth, you get reduced spending by consumers. And since consumer spending is the absolute main engine of the U.S. economy, that is a massive deal. Now, it's absolutely crucial to add a little nuance here. We aren't in a freefall. While the overall unemployment rate hasn't spiked yet, it remains relatively low. This sharp slowdown in hiring raises some serious concerns. It basically tells us that the U.S. economy is beginning to lose its momentum. The engine is definitely still running, but it is noticeably cooling down. So the really crucial point here is, with the economy visibly losing steam, how will the Federal Reserve navigate this exact slowdown? They're the ultimate decision makers when it comes to the cost of money in the United States, and this single data point just threw a massive wrench into their plans. Which brings us to Section 3, the Federal Reserve's next move, balancing the risks. This is the second ripple of our story, focusing squarely on the central bank's upcoming strategy. The Fed is basically walking a tightrope right now. On one side, years of aggressive rate hikes have been strictly aimed at bringing inflation down to their target levels. But if they over-tighten and raise rates further while job growth is already weakening, like we just saw, they risk pushing us straight into an outright recession. They have to perfectly balance maintaining the fight against persistent inflation against the risk of completely stalling the economy. Interestingly, this jobs miss actually acts as a bit of a pressure release valve. As investment strategist Joachim Clement notes here, because the labor market is cooling on its own, it kind of does some of the Fed's work for them. This slowdown gives the Fed vital breathing room to just pause, sit back, and evaluate inflation data before making any major moves. In fact, as Clement points out, a lot of analysts now believe we will not see another interest rate hike for the rest of the year. All right, Section 4, how markets are reacting. A counterintuitive shift. Let's look at the third ripple to observe the incredibly surprising way Wall Street reacts to news like this. It feels weird to say, but lower job growth can actually benefit stocks. Why? Well, because when jobs data is weak, investors immediately anticipate that interest rates will stay lower for longer. Lower borrowing costs are fantastic for companies, and it makes investors way more willing to buy riskier assets, like equities. However, there's a clear drawback here too. The same economic slowdown creates major anxiety. If consumers are spending less, that creates a huge cloud of uncertainty around future corporate profits and earnings. It's a constant tug of war between cheaper money and lower earnings. Finally, Section 5, what to watch next regarding inflation and the Fed. Let's look at the horizon to see how all these ripples come together. So, to summarize our journey through this explainer today, that disappointing 57,000 jobs data point was the first domino. It highlighted a rapidly cooling economy. That cooling is likely what halts the Fed's interest rate hikes for the rest of the year. And because the employment question is starting to look settled, it shifts all investor attention directly over to the next batch of inflation reports. Those inflation numbers, combined with whatever Fed officials say next, are now the absolute keys to the entire kingdom. Which leaves us with one massive, lingering question that will literally dictate the cost of your next mortgage, auto loan, or business investment. We know they might stop raising rates, but are actual rate cuts finally on the horizon? Or will the Fed just keep things exactly where they are for the rest of the year? As we await the next set of inflation data, that is the trillion-dollar question we'll be watching. Thanks for joining me for this explainer, and definitely keep your eyes on the data.